Hey, how you doing? And welcome to Livewise Buy, Hold, Sell. I'm Ali Selby, and today we'll be taking a look at 3 stocks with some really impressive return on equity over the next 12 months. Plus, we'll also be asking our guests to name their highest conviction pick for the year ahead. To do that, we're joined by LSN Capital's Nick Sladen and Elves Adrian Esquero. First up today, we have Lovisa Holdings. It has a return on equity forecast to be around 121% over the next 12 months. For context, the industry average is around 24%. Nick, I'm going to start with you today. Is it a buy, hold or sell?
It's a hold for me, Ali. It's a fantastic fast fashion story. They've just recently opened their 800th store. They're opening over 3 stores per week, so they're certainly not standing still. But we're a bit cautious on the global consumer, and on 27 times earnings, it's a hold for us.
Okay, its share price has risen around 25% over the past 12 months. Over to you, Adrian. Is it a buy, hold or sell?
Lovisa's a buy for us. We think it's a wonderful company, as you've noted, highly profitable and a wonderful example of self-funded growth. We think there's a real opportunity for Lovisa to approximately triple its global store footprint over the coming decade. Of course, that does come with execution risk, but the store level economics for Lovisa are exceptional. It's currently on a reasonable free cash flow yield, and we think that ratchets materially higher as they further roll out their store network.
Okay, next up we have OFX Group. It has a forecasted return on equity of around 20%, which is around the industry average. Adrian, staying with you, is it a buy, hold or sell?
Perhaps it's a bit harsh, but it is a sell for us. OFX listed on the ASX about a decade ago. Over the same time frame, operating margins have halved. We actually think that is reflective of quite a competitive global transfers market. We do give credit to management for recent execution. A lot of that growth though has come from M&A, and we think the risk of competitive erosion remains for investors. Therefore, it's a sell for us.
It's been a difficult 12 months for OFX Group. Its share price has fallen around 30%. Nick, over to you. Is it a buy, hold or sell?
We think it's a buy. It's trading on around 12 times earnings, which is an attractive multiple. They recently gave an AGM trading update where net operating income was up 18% on the prior corresponding period last financial year. They'd shown some real strong improvements in their corporate business. This business has moved from predominantly a consumer business to a corporate business over the last decade since they've been listed. The consumer business, which has had some challenges, started to improve a little bit better. So from our perspective, valuation looks good. We think there's good opportunity for them to take share from other global payments businesses, and it's a buy from our perspective.
Okay, last up today we have healthcare darling Pro Medicus. It has a return on equity of 45% over the next 12 months. Staying with you, Nick, is it a buy, hold or sell?
Pro Medicus has done a magnificent job growing its business globally and executed terrifically well. But from a valuation perspective, it's on over 90 times earnings and 60 times EV to EBITDA. We've got other opportunities from our perspective, and so it's a sell.
Its share price has risen around 37% over the past 12 months. Last one for you, Adrian. Is it a buy, hold or sell?
Pro Medicus is also a sell for us. We tend to agree with Nick. I think it's an exceptional business. They've got a wonderful market position within US diagnostics imaging, particularly within academic hospitals. And it has all the hallmarks of quality, very highly profitable, high margin business, strong balance sheet. It's also founder led. So there's a lot to like about the business, but the reality is we think that its valuation more than captures that quality, so it's a sell for us.
Okay, we asked our guests to bring along one of their highest conviction stock picks for the year ahead today. Really excited for this. Adrian, what have you brought for us?
Our pick is Navigator Global Investments. So Navigator is an alternative asset manager. In more recent times, they've been building up their strategic division, and this basically owns stakes in a range of other asset management firms. And you'd liken it to the Pinnacle model here in Australia, which is highly profitable. And in the case of Navigator, it's becoming the dominant earnings driver for the business. We like it at the moment because it's currently presenting with a free cash flow yield in excess of 15%, which is obviously attractive. And that's post the deal to acquire the remaining stake of a strategic portfolio from Dial Capital Partners. So Navigator enters 2024 with a clean balance sheet, US $26 billion of assets under management, and the great ability to grow into a significant pipeline of opportunity. We think it's an under the radar small cap, and therefore it's a buy for us.
Okay, Nick, your time in the hot seat. What's your highest conviction stock pick for the year ahead?
We really like IPH. IPH is a trademark and patent business with operations across Australia, New Zealand, Southeast Asia, China, and recently it's expanded into Canada. Global sovereignty, technology, they're driving that market from what's traditionally been a growth rate of low to mid-single digits, and we're expecting that growth rate to accelerate over the next 3 to 5 years. And we think that'll drive profitable growth for this business. As I said, they've made some acquisitions in Canada. They made their first acquisition, Smart and Bigger, about 12 months ago. At the results several days ago, they recently made another acquisition. They're now around 20% of the Canadian market, and they're dragging profit margins of those businesses up from around 20% to over 30%, where the rest of their group margins are. Their Australian businesses started to show some good signs of growth. It trades on our numbers on around 16 times earnings. It's got a 4.5% yield, really attractive return on equity. Management has really good skin in the game. The CEO has been there since 2015, has got over $80 million of shares, and we think they're well placed to deliver 10% earnings per share growth over the next couple of years.
Okay, I hope you enjoyed that episode of Buy, Hold, Sell as much as I did. If you did, why not give it a like? Remember to subscribe to our YouTube channel. We're adding so much great content just like this every single week.